Okay, welcome to another video, and today we're going to be looking through a couple of charts on the bond market. And so we're going to be looking at here specifically is the weekly macro firms report from a couple of weeks ago, and this is the report that went out to subscribers. Basically, so the report is aimed at multi-asset investors, very much taking the sort of institutional research approach to global markets, asset classes, and very much chart driven, very much indicator driven, as you'll see in today's video. So the first chart that we're going to look at here is that of bond sentiment, and this is a composite indicator that I've put together, and it incorporates so futures positioning, bond volatility, global sovereign bond market breadth, and also bond mutual fund flows. And essentially what it's designed to do is record or bring in signals that that show when sentiment is being stretched in either direction. You can see when it gets stretched to the lower side, and that's basically people expecting even more lower yields, i.e., people getting very bullish on treasuries. That's often when you see a short-term bottom, and when the conditions are right, it's when you see a turning point. Such as around the middle of last year. Middle of last year you had the sentiment reading there reach an extreme, and that was actually around the time where the economic indicators had started to pick up. So you want the sentiment to be lining up with other factors as well, and that'll be something that we'll look into a little bit more after this one. And so you can see there it got to an extreme level there. And often when it hits the extremes, it's going to take a pause, it's going to take a break, and even turn around. When it gets to those levels, it's basically people being, too bearish on treasuries, and positioning's a bit too stretched and kind of needs a shakeout or a reset if it were to move higher. And and I certainly think that would be in my base case, that it would, that bond yields will move higher. And why do I think that? Well, let's have a look at a few of the other charts here. These ones, so if you think about sentiment's probably one of your more short-term indicators. And the next three charts that we're going to look at are actually very much on the long-term front. So what we're going to look at here is perhaps one of the best explanations for the level of bond yields that you can sort of come up with, and that is nominal growth. And so we've got the long-term nominal GDP growth rate for the US, and that is the 10-year compound annual growth rate. And we've got that actually going out a bit there. That's using IMF forecasts, and so it's pointing to a level of around 4%. That's based on the IMF data, sort of tacking that on to the BEA data that's from the history there. If you think about 4% nominal growth, you split it out, inflation, even if you go with a sort of conservative approach on inflation, just say that the Fed, for argument's sake, hits its target of 2%, run with that, then the other 2% has to come from real growth. That would have to come usually split into productivity growth and population growth. For the US, it tends to see around 1% population growth. Labour force growth tends to be a little bit lower than that due to the demographics. But if you think about America, productivity growth has been a pretty strong point, at least historically. And you think about what's driving that rather than the actual numbers. You think behind the numbers. There's a lot of innovation and technology that goes on in America, a lot of entrepreneurship, and time and again new industries have popped up through the ages, some that you wouldn't have even expected or anticipated. And who knows, the next productivity driver could be electronic vehicles, or any number of emerging technologies that are yet to sort of show their face. But in the immediate term, even just a reversion to sort of the kind of normal growth rates around 4%. Maybe you don't get back to that sort of 5% level, but even 4%, even sustaining or maintaining the current longer term growth rate, you'd say that bond yields look a little bit on the low side against that. Then moving on to other sort of a little bit more obscure indicators. So the first one is real yields. And really the idea with both of these charts is that over the long run, for both of these indicators, the other one there is the term premium, so the compensation that you get for holding longer term bonds. Over the longer run, you tend to see mean reversion here. It looks a little bit of a messier mean reversion for term premiums. But even a more conservative mean reversion there to the 20-year average would see some upside from that factor. And on real yields, it's at fairly extremely low levels, and we've seen this happen a couple of times around there and there. And again, even some conservative mean reversion would have that as a sort of a contributor to higher yields. And you can get structural changes, permanently different levels of, real yields in this case, or a permanently different term premium. Maybe you do, but, the reason why you use mean reversion is that it gives you a fairly unbiased sort of indication of where things might go. You can sort of throw all those things out the window and just say, over the longer run, it's we should see at least some level of mean reversion. And oftentimes, when it gets to extreme, that's when the idea of mean reversion gets challenged the most, and people start to get into a bit of an allure of thinking that we might be in a permanently different regime. Like, we got sort of tempted into thinking that we're in for permanently lower bond yields or permanently lower real yields around there, and already it's proving not to be the case. So when I think about these two charts, and then again this one here, the sort of longer term views, they tend to make me think that while it could take some time for the bottoming process in bond yields to occur, it looks like it is probably the right thing to assume that bond yields have probably found their lower point around here. And from a short-term timing perspective, one barrier to higher bond yields short-term has been removed, and that sentiment has reset. And now it's really over to the economics, and so far I would say the economics are holding up fairly well. We're seeing fairly solid global trade growth, solid levels of manufacturing growth globally, and also property prices in the major economies still heading up. So that would give me certainly a bit of a bearish view on bonds. But then again, we've got to keep an eye on the data, and later this week get the flash PMIs, which will provide another insight onto that. So, the report here is aimed at multi-asset investors, and I guess one thing that I would highlight that most of you already know is that bonds are they're still useful as a diversifier, and maybe not as certain to give you capital preservation as cash would per se when you see these types of conditions prevailing. But it's you wouldn't necessarily not own any at all, is what I'm saying there. So that's I'll leave it there, and if there's any questions or comments, please leave them in the section below, and feel free to fire through any questions. If you want to have a look at the report, this particular one, or if you wanted to take a trial of the report itself, then click through in the link in the information section, or go to the website there. The website's there, topdowncharts.com, and we'd love to hear from you.